One Up on Wall Street Part 6, the final lesson of the long-term view. In Part 5, we saw that the story of a stock is not complete until earnings, PE, debt, cash, inventory and ground facts support it. There, Peter Lynch made it clear that a beautiful story can excite an investor, but only the numbers reveal whether the company is truly strong or running merely on imagination. However, Part 5 left one final fear behind. Suppose you found the right company, checked the facts, and even bought the stock. Now the real question is, what next? Imagine the market is suddenly falling. Red color is spreading across your portfolio, your phone is constantly blinking, and your mind is asking, should I sell, hold or buy more? This is the exact moment where many investors forget all their learning. Because buying a stock was difficult, but making the right decision during a drop is far harder. Now the biggest truth of the entire series is about to come forward. Is the final lesson of investing to find a perfect stock, or to maintain the right behavior with the right stock? For Peter Lynch, a long-term view did not mean holding blindly forever. A long-term view meant giving time to the business, but also changing oneself when the facts change. Because a stock certificate is not a religious vow. You bought the company because it would become a better business. If that very reason vanishes, attachment can become a loss. You selected the stock, understood the category, checked the numbers, and now it's time to invest. But before investing, the question of price stands up front again. If the PE ratio is lower than the industry average, it can be a good sign. But getting happy simply by seeing a low PE is also a mistake. A high PE can show that the market holds high expectations for future growth. But sometimes this exact expectation makes the stock overvalued. A low PE can indicate that the stock is undervalued, but sometimes a low PE is also there because the business is weakening. That is why Lynch says, do not make price the sole judge. It is necessary to look at inventory, cash flow, cash position, debt, growth plan and business quality together. Another myth breaks. Expecting a 25 or 30% return every year from the stock market can be unrealistic. In some years you might get a big return, in some years very little, and in some years even a loss. An investor's maturity lies in building a real process, not chasing fantasy returns. This is where portfolio design comes into play. If you have several well-understood stocks, the chance increases that one of them turns out to be a multi-bagger winner. But this does not mean that you add too many names without understanding them. A portfolio is a responsibility, not a collection. Risk might seem low in slow growers, but the return can also be limited. Here, dividend stability and behavior during a recession become very important. Stalwarts are strong companies, but it is essential to buy them at the right price as well. A good company at an expensive price can yield ordinary results. Fast growers are exciting because large profits are possible in them. But along with them, the danger of growth slowdown, debt and overvaluation is also fast approaching. Timing matters a lot in cyclicals. In good times they may look cheap, but as soon as the cycle turns, the ground beneath earnings can slip away. In turnarounds, the recovery story is powerful, but this is a high-risk zone. Here, you have to look at the survival plan and balance sheet, not hope. Asset plays can feel like hidden treasure. But an asset is useful only when the value unlocks and the company is not sinking under a burden of debt. Now the question arises, when to buy? Lynch's answer is simple. When you are convinced that the stock is investment worthy and the price is sensible. A market drop often provides an opportunity. When good businesses become cheap due to fear, a prepared investor can stay calm and think. However, not every drop is an opportunity. If the business itself is deteriorating, a falling price can also be a warning. Buying a cheap stock is not investing. A bad company can turn out to be expensive even after getting cheaper, because a loss happens in real money, not just percentages. If a company is not performing well today, it is not necessary that it will fix itself in the future. A turnaround demands proof, not prayers. This is the heart of the long-term view. You stay attached to the thesis, not the price. If the thesis is alive, show patience. If the thesis is dead, exit. A long-term investor is not someone who never sells. A long-term investor is someone who gives enough time to the business, but does not lock themselves in denial. Now comes the hardest question: when to sell? Because in selling, ego, fear, regret and greed fight all at once. Peter Lynch explicitly says there is no single formula that fits every stock. The sell decision changes according to the category. In a slow grower, if a 30 to 50% appreciation has come, or the dividend story is weakening, an exit might be worth considering. In a stalwart, one should be careful when the PE moves far above its normal range, or growth does not remain as strong as the price expects. It is crucial to understand a cyclical near the end of its cycle. If demand is peaking, inventory is rising, and prices are weakening, a danger signal might appear. A fast grower might need to be sold when the PE climbs irrationally, growth slows down, or the expansion runway begins to end. The time to sell a turnaround may come when the turnaround is complete and the market has already factored the recovery into the price. An asset play can be held as long as the asset value is intact and debt does not become a problem. But after the value unlocks, expectations must change. This is where the most common mistake of investors surfaces. People sell winners too quickly and hold on to losers out of hope. Because in profit, there is fear that the gain might disappear. In loss, there is hope that the stock might come back up. However, the market does not deal with your emotions. It only keeps account of business reality, expectations, and price. During a drop, the first question should be, is the original story still intact? If yes, the decline could be an opportunity. But if the story is broken, earnings are spoiled, debt is rising, or management is making excuses, averaging down can become dangerous. Position sizing also saves an investor. Do not put so much money into a single stock that as soon as it falls, both your sleep and judgment disappear. Holding too many stocks is also a problem. If you cannot track the companies, your portfolio will become a burden, not a tool. Money can be rotated among good opportunities. But rotation does not mean restless trading. It means a thoughtful movement toward better risk-reward. Cash can also be a part of the strategy. If there is no good opportunity, waiting is also an action. It just does not look dramatic on the screen. Rechecking the story is a vital part of ownership. An investor's job does not end after buying a stock, rather it begins. The 2-minute drill is useful both before buying and after. Can you still explain in 2 minutes today why this stock is being held? If the answer is merely it will go up sometime, that is not a thesis, it is wishful thinking. If the original reason is gone, selling is not a weakness. It is the wisdom of protecting capital. Selling does not mean admitting defeat. Many times, selling is what keeps an investor alive for the next better opportunity. Holding also does not mean simply sitting back. Proper holding involves monitoring with patience and humility along with monitoring. In Part 1, the journey began with the hidden edge of the ordinary investor. Peter Lynch explained that clues are found in daily life which Wall Street notices late. Part 2 showed that professional investing has restrictions, but an ordinary investor enjoys freedom. Then the mirror test showed that the real fight is with one's own emotions. In Part 3, the weakness of market prediction was exposed. The cocktail theory revealed the crowd mood, and company categories explained the personality of a stock. Part 4 revealed the hidden formula of the perfect stock: a boring business, repeat demand inside a stake, reasonable price, and staying away from hot stories. Part 5 brought the story to the court of numbers. Earnings, PE, cash, debt, inventory, and facts demonstrated that excitement needs proof. Now, Part 6's final revelation is that the edge in investing is hidden not in some secret tip, but in the process. Observing, understanding, verifying, buying, rechecking, holding, and selling when necessary. This is the complete chain. Yet, the weakest link in this chain is often not the company but the behavior of the investor. Greed makes one buy quickly, fear makes one sell quickly, and ego does not let one admit a mistake. Peter Lynch's learnings offer no guarantee. Risk will remain in the stock market, mistakes will happen, and not every research will convert into a profitable result. However, the difference is that an investor with a process learns from a mistake, whereas an investor without a process blames every loss on luck or a market conspiracy. Ultimately, the stock market does not become gambling if you think like a business owner. But that same market turns into gambling if you buy purely excitement without facts. The whole story of this series arrives and rests on one simple truth. Getting one up on Wall Street is not about fighting experts, but about educating yourself. Because a true investor is one who can listen to the voice of the crowd, but makes decisions in the light of their own understanding, patience, and facts. This is Peter Lynch's final lesson, and perhaps this is the quietest yet most powerful truth of investing.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.